I'm Shannon Lamont, and I lead the International Tax Services Group as part of the National Tax Office of Eide Bailly. So an IC-DISC is an export tax incentive that's set up for U.S. companies that manufacture in the U.S. and then export overseas. IC-DISC stands for Interest Charged Domestic International Sales Corporation. An IC-DISC requires that a separate U.S. corporation be set up. This U.S. corporation can be owned either directly by individual shareholders or by the operating company itself. The way that the IC-DISC works is that the operating company that is exporting product will pay a commission to the IC-DISC. That IC-DISC is not taxable, however. The income that is paid to the IC-DISC is taxable upon dividend to the shareholders. The benefit of an IC-DISC is really twofold. First, there's the benefit of the rate arbitrage. So income that is typically taxed at the highest individual or corporate tax rate would then be taxed instead at the lower dividend or capital gains tax rate. The second component is a deferral mechanism where the IC-DISC can be used to defer taxation of income for a future period in time. IC-DISC most benefits closely held businesses that are set up as pass-through organizations, such as an S corporation, an LLC, or a partnership. Pass-through entities and their shareholders are able to take advantage of an IC-DISC so long as they manufacture in the U.S., or at least part of their product is manufactured in the U.S., and they export the product. Essentially, the way that the IC-DISC works is that it reduces the operating company income that ordinarily would flow through to the shareholders and be taxed at the ordinary income tax rates. And it brings it into the income by way of a dividend from the IC-DISC at the lower qualified dividend rate. We recently helped a client set up an IC-DISC where the IC-DISC is actually owned by a UK parent company. What we were able to do here is shift the US income from being taxed at the ordinary rate of 35%, and now it's only subject to a dividend withholding tax of 5%. And the way that we structured it allowed them to, in the first full year of activity, save $400,000 of tax. Because of our wide range of experience, really if a situation with a client crosses a border, we can help. So if it's, whether it's individuals or corporations, if there are two jurisdictions involved, it's really important to consider multiple aspects of how they're being taxed, both in the local country or outside of the U.S. and in the U.S.